Thank you so much. As you all know, the financing gap towards the SDGs is increasing. And as aid is at a turning point, private capital mobilization is essential, basically. So let's have a look at what we achieved over the past year. Let me just get that back here. We managed to have a record high of new investments of 8.4 billion Norwegian kroner in 2025. These investments help mobilize an additional 17.8 billion Norwegian kroner. Quite some impressive numbers, but they actually don't tell us the full story. First of all, the total amount of private capital going into these projects is much bigger. This is the number that's attributed to Norfund according to the official OECD methodology. It's a bit technical, so please bear with me. Secondly, this number is only reflecting what happens at time of investment. It doesn't tell us anything about what happens afterwards in terms of private capital going into these projects. So let me take an example. Sahel, it's an Indian company developing and operating biomass and solar energy projects. It's a holding company. You have the structure. It's providing then equity into a portfolio of renewable energy projects that enables them to raise debt financing from both public and private investors. Put a bit simply, we invested in Sahel 4 years ago, providing 1 billion Norwegian kroner in equity capital. That enabled the companies to raise debt financing these renewable energy projects from both public actors worth 3 billion Norwegian kroner. In addition, they were able to raise debt financing worth 5 billion Norwegian kroner from private investors. In addition to that, Sahel is planning to get listed on the stock exchange later this year, a so-called IPO. But our numbers do not reflect what happens later on. They only capture what happens at the same financing round as we invest in. They do not tell us when private capital comes in at a later stage or through an exit. Our third point is that it does not tell us anything about when and how difficult it is, or how difficult it is to mobilize this private capital. So let's take 2 examples just to illustrate this point. In the first case, we managed to mobilize 6.5 billion Norwegian kroner, or 8.5 Norwegian kroner per NOK that we invested. In the second case, we mobilized 50 million Norwegian kroner of private capital, or 0.3 kroner per NOK that we invested. The first case is a rather similar structure to the previous example. It's an investment we did last year called Anthem in a renewable energy company in South Africa. It's the same structure. We provided 760 million Norwegian kroner in equity finance for the holding company that was then channeled down to a portfolio of renewable energy companies that were then able to raise debt financing from private investors. The second example is a financial company that we invested in just recently called Growth Investment Partners Ghana. That company is providing flexible debt financing in local currency for SMEs in Ghana. We often see that it's much harder to mobilize private capital into these less mature markets and sectors like SMEs in Ghana as compared to more mature markets and sectors like large-scale renewable energy projects in India or South Africa. But that does not mean that one is more important than the other. I'll leave it to the next panel to explore a bit further who these private investors are and what it actually takes to bring them into this party. So please welcome on stage my colleague, Cathrine Conradi.
To join? What is this? Okay, good afternoon and welcome to this panel. We will together elaborate a bit more on mobilization and how to unlock more private capital where it's needed the most. I really look forward to learning from our panel and hope you're too. Company's perspective from Monica, investors' perspective from Kiran, and then the expert, Sony.
I'm the guy who cracks the jokes.
And comes late, right? Or no?
But of course.
I hope for a frank, practical conversation about what is working and what's still getting in the way. So starting with you, Monica. You sit on the board on ERCO Energía, a solar company in Colombia, where Norfund is an investor. And ERCO has been successful in raising both equity and debt. But if we go back, let's say a year or two, what was the hurdles you met when attracting the capital you needed to grow ERCO?
Well, actually, we did face hurdles, and we are currently facing more because we are in the midst of raising $100 million for our Series C round. And operating in a developing country, in an infrastructure company, the hurdles are many, because when you are raising capital, you have to be able to identify, explain, present to potential investors all of the different issues that you are facing as a company, how you are managing your risks, and what is your business plan, how you're gonna attain it. So it's a lot of information that you have to provide. You have to be certain about it. You have to be very professional about it. And to be honest, it's like the real test for what you're doing within the company, because it's where you're really showing if you have had results, if you understand what you're doing, and if you can provide a clear forecast of what is going to happen with the company in the future.
But you did explain to us in a good manner and convinced us to invest in ERCO. When Norfund came in addition to the capital, what did we bring?
I think Norfund brings so many valuable things, because not only the capital is going to cut it, and for other potential investors, for banks in particular, it is very important that they can see the actual added value in terms of governance, the actual value that you bring in terms of experience. And one of the first things that they look at is the due diligence that you have made as an investor. It provides a lot of security to banks, to lenders, and to other investors of how you looked at the company, how you checked all the boxes, and that you feel confident that it's a good investment.
And I think some of the things you mentioned is what we often call making a company bankable or investable. So I want to turn to you, Kiran, as an investor. You lead responsible investments in KLP, and we should also, and I think it was already mentioned, you also sit at the board of Norfund. And KLP has been investing alongside Norfund for a long time, and with pretty good results. But yet we haven't seen many other Norwegian institutions follow. What do you think is holding them back?
Well, first of all, I think the reason for why I can say something about it, because I work in asset management, and then we have other external institutional investors who invest in our funds. And I would say it's a combination of actual risk and perceived risk. That's one element. That it will, for a lot of them, it makes sense to just replicate some of the indexes, and you can get the same high return on the investment. And the other thing is that it is also lack of competence among a lot of them, that it's mainly because these markets have quite high political risk. But we also know that suddenly we have political risk related to the US, which we are not used to, I think. So it also maybe demands that we have a much more nuanced approach to a lot of these markets. But I also have to say that I think it also has to do that you don't have the in-depth competence. It requires a lot of work, and a lot of the asset managers and asset owners are quite conservative as well. But we're also lucky that we have the largest sovereign fund, and we haven't really been able to use that for any other purposes, also for maybe like narrow-minded approach to how we invest that money. So I think, if we could that's a discussion for the politicians to take. But I think if you could have used some of that to use it for other purposes, that could maybe have inspired some of the institutional investors in Norway. And one thing I can also add, I think from Norfund point of view, that we have an understanding of why people don't want to understand, but I think it's also important for us that we work a little more systematic, that maybe we map, what are the concerns, and then you make products which might be relevant for that market. We have a new CEO now, so this is also a responsibility for the board that this is something we should look into. But just one last thing, that it is a regulation which is called SFDR, Sustainable Finance Disclosure Reporting Regulation, and there it is a revised regulation, but you see that with the revised regulation, impact funds would be part of that regulation, so it might open up a room for some of the institutional investors, but I think then it requires that you have the right products in order to gather some interest.
But it was before your time at KLP. But how, if you know, and you probably discussed it, how and why did KLP get comfortable in investing alongside Norfund in developing markets?
As I have been told, that it was an invitation which KLP got back in 2008, and then we wanted to have that conversation. But I think it also has to do that we have leadership who wanted to take that extra risk, because back in 2010 and 2011 there were not many actors who talked about impact funds. So it really has to do with the leadership, that you need to have the leadership who wants to able to take risk, not what everybody else is doing mainstream. And this might also reflect why KLP had that partnership. And I think the partnership with Norfund, that it helped you to reduce the political risk at least, was a comfort for KLP to do so.
And then Sony, these things you've heard from the other panelists, probably not new. You've been looking into blended finance instruments, guarantees, and what needs to happen to bring investors like KLP along. You recently also co-authored a new paper critically examining these instruments. So is the answer to the hurdles we've heard within these new instruments, blended finance, guarantees?
The short answer is no. Anything that requires subsidy is automatically not scalable. And particularly at a time, as we heard, overseas development aid budgets are shrinking dramatically. And to take that away from basic humanitarian aid in order to subsidize asset managers who would already, on a risk-return basis, benefit massively from reallocating the 50 to 60% average exposure they have to the key person risk of Donald Trump, to the deteriorating institutions in the United States of America, to a declining dollar, to all of the tailwinds that drove the supernormal returns in the United States having either become headwinds or have stopped being tailwinds, is a complete dereliction of fiduciary duty. So essentially, we and our communities responsible have ended up in a ridiculously bad corner by, on the one hand, saying these are amazing investment opportunities, and then offering a first loss guarantee, technical assistance, junior equity, hybrid equity, all kinds of 3-4 layers of subsidies often, which are sending completely opposite signals, right? First, and the big problem is, on average, if you look at the Norwegian Sovereign Wealth Fund, the other large asset owners, one single employee, broadly speaking, is responsible for $2 to $4 billion of allocation, right? Now, not only do these people not have the time to do diligence on a $10 million project in geothermal in Kenya. They don't even have the time to talk to people who have the time to do that due diligence, right? So we are talking about what is essentially our community, which is a cottage industry. And I'm terrible. It's terrible that we have to sort of be self-deprecating, but that is the truth. And at the same time, talking ambitions, billions to trillions. Those trillions will not materialize in a cottage industry. So a lack of ambition, having gone down the wrong road of assuming that subsidies are required, are the two dead ends that we now need to reset. And there has never been, the news is full of terrible bad news flow. It's a depressing time, right? But let me suggest some very positive interpretation. There has never been a more promising time to chase literally trillions of dollars of capital to be reallocated to emerging economies. The US is 4% of the world's population, 51% of private equity, 40% of bond markets, 2/3 of global listed equity. Emerging economies are 85% of the world's population, driving 2/3 of global growth, having 26% of bond markets, 10% of global equity markets, and you tell me which way the wind is blowing. And this rebalancing started last year, and I wrote a piece about this on the first anniversary of a theme I coined last year, the beginning of last year, in a keynote, and which was the great global rebalancing, in which I took the opportunity to thank President Trump and this administration for finally making people realize what a massive one-person key point of failure bet they had made over the years, including our oil fund. If the oil fund reduces, for example, its allocation to the United States from 53% to 40% over the next 4 or 5 years, that's $250 billion looking for opportunities elsewhere. There has never been a better time for outfits, including Norfund, BII, IFC, our DFI community, to mobilize unprecedented amounts of capital, because we have, in Norway, for example, the deepest expertise on the countries, on the regions, on the industries where all future growth is going to come from. And last but not the least, there is this idea that it requires higher returns. That goes completely against finance theory. I used to be a professor of finance, and I happen to know this, that in fact, it makes sense to reallocate up to 20 to 30% of our portfolios in emerging economies at return expectations that are 2 to 3% lower than what you would get in the United States, and your portfolio would still be better on a risk-return basis, which is what Finance 101 says. Never been a better time.
I agree. We do agree. We know the money is there. So I've been thinking a bit about like the mobilization. We're focusing on the big institutions, international capital. But then if we go to ERCO again, also the mobilization on local or regional capital. Do you see any differences when trying to mobilize capital internally in Colombia versus then talking to international investors?
Definitely. Again, as I was saying, when you are bringing in an investor, you have to explain many things. When it's an international investor that doesn't know you, that doesn't know the country, that doesn't know what's happening, you have to check a lot of issues out of the way, explain regulation, and explain political, economical issues. When you have a local investor, otherwise you just have half of the list to confront and to present, which is more related to the actual corporate operation and finance, etc. However, and unfortunately, the local investors usually don't have the capacity in terms of capital to bring in the resources, for example, that we need. They cannot do it. So they might understand more, but still they cannot compare to the potential of a DFI or for international investor.
Or maybe that's also something on the perceived risk, that the further away, the more perceived it is. And then I saw you wanted to comment, Kiran, on something Sony said, maybe on this moving the institutional capital.
Sony, I don't think this group needs to be convinced. I think it's the Ministry of Finance who needs to be convinced. But I agree partly in what you're saying, but I think coming from, where a lot of the asset owners and asset managers, pension funds, they are not supposed to take high risk. And it is also a fact that the US economy is still really strong, despite the political risk. And we saw that it was a lot of flow in the emerging market funds after the changing landscape in the US. But on the other hand, the high returns is really what is driving the demand. And we see that there is a gap between how you assess the European markets and developing and emerging markets. So.
I see the clock is ticking. I have tons of more questions. So if anyone wants to, for the mingling after, you can have some here. Sony, one last, and you see the clock there, so you have 30 seconds.
30 seconds.
To wrap up, one challenge, either through Norfund as a DFI or some of the policymakers in this room. What should we do differently for next year's conference, or between now and next year's conference on mobilization?
Even today, 2/3 of the average institutional investor and diplomatic services in Europe think the birth rate in Bangladesh is 5 rather than 2, have never heard of the geothermal potential in Kenya, have never heard of Nollywood, one of the great cultural successes in Africa. And it is incumbent upon us and our failure to have failed to do that, even though all of these people I spoke about can name 30 MAGA agitators, Steve Bannon, Marjorie Taylor Greene, and obscure senators from states we will never be to, right? So cognitive headspace is the single most scarce resource, and for so long have we been captured by the United States, and so dominant is every blow-by-blow account of the next tweet or Truth Social that we fail to update ourselves in the rest of the world. And it is our job in this country and our responsibility to make sure the Norwegian politicians, finance ministry, NBIM, KLP, everybody else fully knows how amazing, wonderful, entrepreneurial, creative, and innovative so many people in the majority world are. And that is what is required for us to be able to look away from the United States towards where the future belongs.
Great. I think we have to run off stage. So thanks a lot for your contributions.
Thank you so much.